weighted average cost of capital, or what they call the WACC, W-A-C-C, is probably the biggest topic. There's a few other things we'll talk about too in the chapter, but we're going to talk a lot about what that means. What is the cost of capital and its components? So when we talk about capital from the perspective of Chapter 3, what we're really talking about is the fact that companies finance themselves, and think corporations primarily, with a combination of debt, which is borrowing money, issuing preferred stock and issuing common stock, and also using your own internally generated retained earnings. So it's really a combination of all of those. So debt and equity, where equity is made up of preferreds, commons, and retained earning. So that's really what this chapter is about, and a little bit about how you calculate what the WACC is and so on. But just think about what that is: weighted average cost of capital. So we're averaging something out based on a weighting, and the weighting is basically a factor of how much of each of these components do you have in relation to the grand total of all the capital that you have. That's really what the chapter is about, with a few other things thrown in there, of course. Alrighty, there we go. My computer was not cooperating with me. So I just want to show you kind of where we fit in the grand scheme of things, the big picture. Now down here we've got the WACC, okay? And so the value of any company project also can be boiled down to this middle formula here. Free cash flow, okay? And free cash flow is extra cash generated by a company above and beyond what it needs for reinvestment, so just extra cash, divided by 1 plus the WACC, and then the 1 and the 2 and so on would be to the power of time, 1 year, 2 years, until infinity. Okay, and so that WACC factor, it's really a rate, really has a lot to do with determining the value of something, a company itself, or projects that the company goes out and invests in. So that's really what that is. So the two components were debt and equity. Remember that equity is made up of common stock, preferred stock, and retained earnings. Okay, and so all these things, these factors, the 2 on the left and the 2 on the right, go into determining what is the cost of each, and that of course then directly impacts what the WACC is. So what's the market interest rate right now? Interest rates change all the time in the economy. Risk aversion. Sometimes investors feel like risk is bad. Sometimes they feel like I want to take on more risk. That just there's an ebb and flow with risk in the economy also. How much debt versus equity does a particular company choose to have on the balance sheet? And of course, the risk of the business itself. Some businesses, some industries just have more risk in them than others do. A new car manufacturer, a airline company would have a lot more risk than a power utility, for example. Okay, so that's just an example. So all those things go into determining what the WACC is. So long-term capital, and this is all long-term debt, primarily bonds. Some use what they call permanent short-term debt. Permanent short-term debt just means I might always have short-term debt on hand to buy inventory, just kind of knowing that too. So sometimes you treat permanent short-term debt as long-term just because you always have it on the books. Preferred stock and common equity. And common equity really means both common stock and preferred stock. So capital components is really, ultimately, it's any source of funding that comes from investors. Okay, that's really what it is. So that's your debt and that's your equity. Accounts payable, accruals, deferred taxes are not funding from investors. They're more accounting things. They're more just things that show up because we have accounting going on. So accounts payable, just short-term trade payables. I'm a retailer. I buy inventory from my supplier. I've got 30 days to pay them back. And accruals just happen as an accounting rule, basically to match revenues earned to expenses incurred in the same accounting period. That's what accruals are. And deferred tax is kind of the same thing. It's just matching your tax liability to your federal tax return. So we really don't take those into account when we're computing the WACC and things like that. Now, this is a big one, before versus after tax capital cost. So in finance, we're very concerned with cash flow. And cash flow is free cash flow after everything's paid for, after all expenses, after all taxes are paid. So we look at everything after tax, okay, after tax. That's the free cash flow, or that's the cost of something. It says here most firms incorporate tax effects in the cost of capital, therefore we focus on after-tax costs. This is a big one though, this bottom one right here. Only the cost of debt is affected. Okay, so a company, a corporation, receives no tax break for paying a dividend. Okay, however, a corporation does receive a tax break for borrowing money because interest expense is tax deductible for a business. Now, you and I as individuals, it's a different story. For you and I as individuals, the only interest that we can deduct is for our primary home and some student loan. Okay, and that's really about it. A credit card loan wouldn't count. Debt on your car, personal line of credit, anything like that would not be tax deductible. However, it is for a business. Really, for a business, all interest is tax deductible and reduces taxable income and reduces your tax payments. Okay, so I really focus on the after-tax cost of debt. There is no tax adjustment for anything involving equity. Okay, that's a big thing I just said right there. So the cost of debt, how do you figure out what your cost of debt is? That's what they're going through here. 3 methods. Ask investment banker what the coupon rate would be on new debt. So the coupon rate is if I am a corporation and I want to borrow money, and one way that corporations quite frequently borrow money is to issue bonds. And so if I went to an investment banker, and that's a banker that helps corporations sell their own bonds and stocks, and I said to Mr. Investment Banker, I want to sell bonds of my company, that investment banker would help me go through the process of determining what's the rate of interest that we should pay in those bonds. So I could ask that. I could go to an investment banker and say, if I did this, what's the coupon rate of interest that I would incur? Method 2, I could find the bond rating for the company and use the yield on bonds with a similar rating. So basically I can find out what is my bond rating, and there are companies out there called ratings agencies. S&P and Moody's are the bigger two, and what they do is they rate any company or any government that issues bonds and gives them a rating. And like AAA is the best, and there's all kinds of letter grades on down. The higher, the better. The higher means the safer the company, the more likely that the company is to repay the bonds. But that's what I'm looking at. So I could find another company a lot like mine and see what its ratings is, and that rating then I could correlate to an interest rate. Or I could look at the debt that I currently have on the books and just use that, basically just find out what that yield is or what the interest cost is on the debt that I already have and use that. So there's really 3 ways for a company to figure out what its cost of debt is. And we haven't necessarily looked a whole lot at time value of money, so I decided to leave this slide in here just as an FYI, as an example. But what this is saying, let's just say I have a 15-year bond. Let's just say I'm a corporation, and I've got some bonds on my books. I've sold some bonds to raise some capital, and it's a 15-year bond, 12% semi-annual. That means semi-annual means twice per year, and that means I have to pay interest at a rate of 12% annually, but I pay it twice per year. And right now, the bond could be purchased on the market for $1,153.72. So just know that bonds, you can buy and sell bonds on a market just like stocks. And what we're saying then, I could plug in some numbers on a timeline, or I could use a financial calculator, or I could use Excel to figure out what the components are. And the things that impact the time value of money are the number of periods, and it's 30, because semi-annual means twice per year, so 2 times 15 is 30. My interest rate per year is, we're solving for that one. We'll come back to that one. My present value is the amount it's worth today, which is the sales price, the $1,153.72. The payment is $60, and the reason it's $60 is this is a $1,000 par value bond, which they don't really tell us. You have to kind of look at this 1,000 down here to figure that out, and the future value of 1,000. So when this bond matures, it'll be worth $1,000. So 1,000 times 12% is 120, but this is semi-annual, so we divide that by 2, which now becomes 60. So every 6 months, interest of $60 is paid. When the bond matures in 15 years, which is 30 periods, it's paid back at 1,000. So essentially what this is saying is for 30 periods, present value of 115,372, a payment of 60 for 30 times, and a future value of $1,000 at the 30th time. All that boils down to an interest rate of 10%, and the answer would come out as 5, but because I calculated this as semi-annual, I have to double it, and it becomes 10. So basically it comes down to being 10%. So this bond's interest rate on the market is 10%, is what they're telling us. So that was method 1. Okay, that was really kind of like method 3. That was really, saying we already have debt on the books. Here's what it is. It costs us 10%. Okay, so here is another big thing, because I keep repeating this about debt because this is one of the questions of the discussion board this week. There is a discussion board this week, by the way. Interest is tax deductible, which I mentioned. So we focus on the after-tax cost of debt. After tax, that's what the AT means. So my R sub D, it just means the rate. R just means rate, interest rate. D means debt. So the interest rate for debt, RD, after tax AT equals RD times BT times 1 minus T. Okay, so it's 10%. We just figured out it was 10%, right here. 10% times 1 minus T, which is the tax rate. Now, they didn't say anywhere else what the tax rate is. They're just saying it's 0.4%. So that is 6%. Okay, that is 6%. Down here it says flotation costs are small, so ignore. A flotation cost is essentially the cost of issuing debt or the cost of issuing equity. If I'm a corporation, what corporations do is they hire investment bankers to say, I want to issue debt, help me do it. And like any banker or broker or in between, they get their cut. And so they're going to typically take a fee. We're just ignoring that in this example. Okay, we're just saying it's small, ignore it, because we want to focus on how a before tax rate becomes an after tax rate. Okay, so that's really what we're talking about. All right, so now let's talk about preferred stock. And a preferred stock is a stock issued by a corporation, and is preferred because it receives dividends, usually guaranteed, and always before a common shareholder would receive dividends. So preferred shareholders receive dividends first. Common shareholders only get them if there's enough cash left over for that the company's declares dividends will be paid. If they only have so much cash to pay out in dividends, the preferreds are in line first. If the money runs out, the commons are left with nothing. Okay, so that's what a preferred shareholder is. And so to compute the cost of capital for a preferred stock is the formulas right here. Let's walk you through each piece. So again, it's that R sub PS, that rate of return on preferred stock, is DPS, which is the dividend. DPS means dividend preferred stock, divided by the price of my preferred stock times 1 minus the flotation cost. F means flotation. Let's plug in the numbers here. 10% and par is 100. That's how you compute the dividend on a preferred stock. It's the rate times the par. 10% times 100, which is $10. I divide that by the price today. That's what the P sub PS is, the 116.95, multiplied by 1 minus the flotation cost. Essentially saying, if I issue preferred stocks, if I'm a corporation issuing preferreds, 5% of any money that I receive, it goes to the investment banker as their fee, essentially. So I get 95 cents on the dollar. They get 5 cents on the dollar. And so that turns into a 9% cost. The cost of preferred stocks is 9%. And the timeline of a preferred would be like this. So essentially then, if I am going to go out, I'm a corporation, I'm selling preferred stocks, and then I end up paying my preferred shareholders. Now this says $10 per year, right? That says 10 per year of dividend. That's what that is. But usually most dividends are paid quarterly. Okay, so that's what they're saying here. So we're just saying DQ means quarterly, and in the vast majority of companies, common and preferreds pay quarterly dividends. There are exceptions, but the vast majority pay quarterly. So what you see here is that 111.10 that came from the previous screen, right here, and that's the 116.95 times 1 minus 0.05 equals DQ, the 250 dividends per quarter, divided by the R per period. And the R per period is, you can see here, is 2.25, because 2.25 is 10% divided by 4, and that's 2.25. And so that comes out with 9% also. So the same answer, which is, we're just kind of proving the answer is really all we're doing with this slide. It says here that if a company does choose to issue preferreds, that the flotation costs are more significant. So they are reflected here. And we're using the net price, the net proceeds that we would receive. So if I sell a preferred stock for $100, I get 95 as the corporation. My investment banker gets $5. I'm going to talk a little bit about risk, and that's one of the components of the chapter. They do talk quite a bit about risk in the chapter. Is preferred stock more or less risky to investors than debt? And it's more risky. And the reason it's more risky is a company does not have to pay a preferred dividend. So if I'm a corporation and I've issued both bonds and preferred stock, the preferred shareholders can't force me to pay dividends. Okay. They can force me to pay interest, though, because that's a contract of, you go to the bank and borrow money, you're signing a contract saying, I'm going to repay you the principal plus the interest, right? That's how that works. So think of it from that perspective. Now, companies, if they're short on cash, could choose not to pay preferreds. Now, at some point in time, that'll be a problem, but they can get by doing that with a few years. That's kind of what the second bullet point is talking about here. You still want to pay that preferred as often as you can, because unless you get your preferred shareholders caught up and paid, you can never pay your commons. Your common shareholders will get a little upset with you. It'll be difficult to sell new shares of stock if you're not paying dividends. And eventually, your preferred shareholders may gain control of the firm with some legal maneuvers. Now, it takes a while, but the bondholders are always first in line with their hands out ahead of the preferreds and ahead of the commons when it comes to getting payments out of the corporation. It says, why is the yield on preferred lower than R sub D, lower than debt? Corporations own most preferred stock. Number one, know that individual investors typically don't own a lot of preferreds. Other corporations buy preferred stocks of other companies. Also, let's talk a little bit about tax. I know it's real exciting, but corporations are double taxed, and so corporations are taxable entities. And when they compute their net income, essentially they're paying a 40% tax on that. Now, with the new tax law that came out, that's much lower. It's now in the 20-some%. But regardless, companies are paying out those, are paying taxes, and then they pay dividends based on after-tax income. So your net income, which is after all expenses, including your tax expense, is your net income. And with your net income, then you are paying your shareholders dividends. Your shareholders receive the dividends, and that's taxable also. So whoever owns the stock receives a dividend and also pays tax. That's the double taxation. So now imagine that you're a corporation and you own preferred stocks of another company. So you're receiving preferred stock dividends, or any dividends really from any kind of stock, but let's say preferred stock dividend in this example. And that increases your taxable income. That's revenue to you. And so that increases your net income, that increases your tax bill, and so on. So that's triple tax. So what the government has done is said to corporations, you can exclude 70% of preferred dividends from taxable income because of the triple tax effect. Okay, so that changes the yield on preferred stocks then. And that's why a lot of corporations own them, is because 70% of those dividends are tax excludable. I don't pay tax on 70% of those. So that's a great investment for a corporation. Two ways of raising equity: directly by issuing new shares of common stock, and indirectly by just reinvesting your earnings into your company, called retained earnings, by just deciding for a while, let's not pay dividends. Let's just keep our earnings and use that to finance future growth and expansion. So there's always a cost of reinvesting your earnings. Any earnings from a corporation can be retained or paid out as dividends. It's very rare that a corporation would pay out all of its earnings as dividends. You want to keep some. There's a fine line there. There's kind of a happy medium of keeping so many and paying so many out. So the opportunity cost is, of course, if I'm paying dividends, my investors now have choices, right? They can take those dividends that they received and they can do something with them. They can buy more shares of stock. They can use it to fund retirement, fund college education, whatever it is, right? It's up to them. They do with it what they want. If the company doesn't pay the dividend, of course, our investors can't do anything with that. So that's the opportunity cost. And opportunity cost is, it's about choices. If I choose one path, I can't choose the other, right? If I'm a factory and I'm a manufacturer and I've got some empty floor space in my factory, I maybe have two choices. I can maybe lease some of that space out to another company and they can make something, or I could buy a bunch of equipment and try to expand my product line. I can do one or the other. I can't do both. That's what opportunity cost is. Once we've chosen one path or one direction, we've given up the opportunity for the other choice. So that's what they mean by that. So the opportunity cost then is the return that stockholders could earn on alternative investments of equal risk. So, if I'm a corporation and did pay a dividend, then my shareholders, I would assume, would invest that in something, maybe more shares of my company or other companies. But if I don't pay it, they can't do that, right? So that's what they mean by that. So we charge an opportunity cost to ourselves when we use our retained earnings. Okay. Now the other big topic in the chapter, which isn't quite as big as just what the WACC is CAPM, and that stands for Capital Asset Pricing Model, CAPM, Capital Asset Pricing Model. Now this discusses there's three ways for a company to determine its cost of equity, and that R sub S, it's a combination of, it says S, think of it as stockholders' equity, okay, stockholders' equity. And it's a combination of common stock and retained earnings. It's really both rolled into one, okay? And so CAPM is a way to figure out what is the return on owning a company's stock. Okay, and I'll go through what the formula is here. So R sub S, the return on owning a stock, is R plus the risk-free rate, or R sub RF. RF stands for risk-free, and risk-free is investments that I can buy that have no risk in them. And the investment I can buy that has no risk is a U.S. Treasury bond. It's assumed that the U.S. Treasury would never default. And so if I buy a U.S. Treasury bond, whatever interest I would earn by buying that, it's fully guaranteed. There's zero risk. Now, the returns are really low, of course, but there's zero risk. So that's the risk-free rate, plus R sub M, which is the market rate. The market rate, so the stock market itself. What's the return on owning the market? Minus the risk-free rate times B. And B stands for beta. And beta is a measurement of risk. All companies have risk to them. Some are riskier than others, as I mentioned earlier. If you were to look at an airline, a car manufacturer, they would tend to have higher betas. If I looked at a power utility, it would probably have a lower beta. The beta of the market is 1. So if I just had the risk of the market, the beta is 1. So any stock with a beta above 1 is riskier than the market. Any stock with a beta below 1 is less risky than the market. So essentially then CAPM is R sub RF plus RP, which stands for risk premium. And risk premium is just simply the market rate of interest minus the risk-free rate. That's RP on the market, there's premium on the market, times B. Because in finance there's an adage called risk and return. The greater the risk I take, the greater return that I should demand for taking on that risk. Okay, so that's CAPM, and we'll talk a little bit more about it. I just want you to kind of walk away from this chapter having a pretty good understanding of what CAPM is. Next is discounted cash flows or dividend cash flow. It's kind of either way. I've seen different books use the dividend or discounted, but either way, we're looking at cash flows typically from dividends. So R sub S could be dividends divided by price plus a growth rate. So D1 means the dividend a company will pay a year from now, divided by the price of the stock today. 0 means today, P means price, plus a growth rate. And that growth rate is kind of subjective. It's really the growth rate of the dividends that we're trying to figure out there. Or we could use the own bond yield plus judgment risk premium, basically saying the R sub S should be the sum of R sub D, the cost of debt, plus some kind of a risk premium for bonds, knowing that some companies are riskier than others, so therefore there's a risk premium depending on what the company is. Now the top one, CAPM, can be done for any company. The dividend cash flow method can only be used for companies that pay dividends. The bottom one can only be used for companies that have debt on the books. Not every company has debt, not every company pays dividends, so CAPM is kind of the gold standard that can be used no matter what. Okay, so but CAPM is the one we're going to focus on. Okay, so market risk as defined by CAPM, and there's a couple little terms here that I haven't thrown at you, and just be aware of them. There's nothing in your homework about these terms. This is just more informational as people taking a finance class, just terms you should have heard as you take a finance class. So W is the weighting, okay, the percent of the portfolio invested in a stock. Sigma M, sigma means standard deviation. Okay, that's what that little, it's like a 0 with a dash at the top. That just means standard deviation. And standard deviation is when you look at the standard deviation, you compare a stock to the market, and what you're doing is saying as the market goes up or down, how does that stock change in relation to the market? That's what standard deviation is. And then PIM is the correlation between the stock and the market. Okay, so it's just kind of measuring. It's kind of a math thing. This is just informational FYI. It's nothing I'm having a calculator or do anything with the homework in. So I talked about beta, and so the beta of a stock is, the beta is basically how does a deviation of the market compare to the price of the stock, and how does that correlation work? Okay, so beta measures the impact of stock value on standard deviation. Okay, what's that? Basically, what's that risk and reward? What's that combination of the stock's beta versus the market change of values compared to the change of that stock? Okay, and that's what they mean. So the higher the beta means the higher the deviation, and vice versa. That's just be aware of that. And so right here, they're just going to plug in and do a CAPM for us. It says here that so R sub S, the cost of stock, is the risk-free rate, R sub RF, plus the market risk premium times B. Okay, so here it is. The premium is 6, beta is 1.2, risk-free rate is 5.6. And so just doing the math, we get 12.8%. It says here, most analysts use a rate on long-term government bonds, an estimate for the R sub RF, because when you think of stocks, you're thinking very long-term. That's the one thing I want you to think about. So the government issues treasury bonds at all levels of maturity. And so generally what most people in finance do is look at what's the risk-free rate on a treasury, or what is the rate on a treasury bond somewhere along the 10 to 20 year term. Now, just know that over time, interest rates change a lot. And so just because this says 3.5%, that rate right now may not be the same as what they're using right here on the screen. But what they're saying is right now, generally on the market, 3.5% to 6% is generally the market risk premium. And so sometimes you can just kind of cut that down the middle, 3.5 to 6. What's the middle of that number? 5-ish, 5.25, something like that. You could use that. Here's the dividend growth model, that R sub S equals D1 divided by P0 plus growth. Here's how I'd figure that one out too. So this only works if a company pays a dividend. I want you to notice though what this says. D0 is 3.26, so a dividend today is 326. But look at the formula here. It says it wants D plus 1, or D1. So D1 is D0 times 1 plus the growth rate. And the growth rate is 5.8%. So D1 becomes 326 times 1 plus G, 1 plus the 5.8%. And then we just do the math down here. We get 12.4%. The price of the stock today is $50. So that's just another way to compute what the R sub S is. Only if we have dividends, though. And of course, that growth rate is very subjective. That growth rate is a growth of dividends or a growth of free cash. Many financial websites will estimate what they think the growth rate for a particular company is. So there's lots of ways that you can look at history for a company and see how much has it grown by in the past. Those are all things to look at. Then we have to look at earnings retention. How much earnings do companies typically keep versus how much they typically pay out? You can see here that suppose a company's been earning 15% on equity. Its ROE has been 15%. Return on equity is what that means. And been paying out 62% of its earnings. If that continues in the future, how will that G, that growth rate, what will happen to that? So the growth rate from looking at retention is this. So the retention rate is 1 minus the payout rate times return on equity. And that just says we come up with a 5.7%, close to the growth rate that we used of 5.8%, saying, it's probably good enough. That's pretty close for the type of calculation we're doing. We're okay with that. It says here, could the dividend growth approach be applied if G is not constant? Yes, it's just more difficult to do. And I'm using this PowerPoint, I've mentioned that previously, from a different book. I'm just using the chapter of a different book that correlates exactly the chapter of our book, but our book that we're using does not have any resources, so I'm kind of forced to use something else. So I just did not notice that I should have taken the second point out. So that's just what's there. Don't worry about that. And then the final way to compute just what the cost of S is, R sub S, is that last method I talked about was the own bond yield plus judgment risk premium. Okay, so we're saying R sub S is a combination of our R sub D plus a judgment risk premium. And so earlier, a few slides ago, we computed that the cost of our debt was 10%. We're putting in a judgmental risk premium of 3.2. It's not the same as your cap M. It's kind of the middle of our risk premium. It's kind of like almost half of our risk premium. It's more of a ballpark estimate. And again, I can only use this method if I have debt in the books. If I have no debt on the books, I can't use this method. It wouldn't work. So the three methods they used, cap M, dividend growth, and the judgment approach. And what we can do is just average those out. But notice that the average is at exactly the cap M. And the cap M is by far the most popular because, as I mentioned earlier, you can use it on any company no matter what, where the other two I can only use under certain circumstances. All right, now let's talk more about the WACC because, as I mentioned, that was a big part of the chapter. The weights. So what's that weighted average, the weights? The percentages of the firm that will be financed by each component. If possible, always use the target weights as percentages of the firm that will be financed with the various types of capital. Always use the target weights. So the way that works is you have your book value. You can look at your last balance sheet. So if you can recall looking at a financial statement, you can look at a balance sheet and you would see a line that would say preferred stock, common stock, retained earnings. It would also be a line for debt or bonds payable or something along those lines. And that's the book value. Okay, that's in a balance sheet is historical. Right? So we're in the beginning of the year in January, and when a year ends in December, a lot of companies their year end is December. When the year ends in December, then we have to issue financial statements, but it takes typically a month or 6 weeks roughly to issue financials about what happens. So companies will be issuing their year-end financials in January and February to say, here's how we did. So when you go and look at the balance sheet, it's historical. It's reporting, here's what our numbers were as of this date. Okay. But when you compute the weighted average cost of capital, it's a forward-thinking number. Okay, it's a number that helps you look at the future. So what companies do is they have targets. They have a target for how much weighting they want to commons, preferreds, and debt. And so we're going to focus on what we want that target to be and make decisions about, as we acquire capital, to affect future balance sheets so they'll be close to that future estimate that we want. Okay. So if you don't know the targets, it's better to estimate weights using current market values and current book values. So always focus more on market value over book value, because market value is more reflective of what's going on today as we're doing the calculation. Okay. So stock always has a market value. Preferred stock has a market value. Debt is a little bit harder one to do potentially. So if we don't know what the market value of debt is, then we focus on just using its book value as a close approximation. So what they're saying here is the stock price is 50, there's 3 million shares, the firm has 25 million preferred stock and 75 million of debt. So how would the weightings be computed then? So V means value. So value of stock is the previous screen, the 50 times 3 million. That's what this is, 150 million. And they just said that preferred's worth 25, debt's worth 75. The value is the sum of all three, which is 250. And so then my weighting's pretty simple, right? It's each divided by the total, 60, 10, 30. Okay? So we used market value, which is more forward-looking than we did book value, which is more backwards-looking. And the WACC number needs to be forward-looking because we used the WACC to make decisions about the future. So the WACC should be forward-looking. That's what they mean by that. Okay, so here's the WACC of our company then. So we went through in previous slides and we computed the cost of the three components: debt, preferred stock, and then stock, meaning stockholders' equity. And so if you recall, and the weighting for debt was 30%. That came from the previous screen. Okay, there's my weightings right there, 30, 10, and 6. Right here. So here's my 30% times my 10% times 1 minus 0.4, 1 minus t, the tax rate. And then I do the preferred one here. That's 10% times 9% cost of preferreds. Then my last one is my stockholders' equity, 60% times 12.8, and I get 10.38, or I can round that to say 10.4. So my WACC is 10.4. So as I am working on future projects and future investments, and I have to know what my WACC is, I use 10.4%. Okay. So what affects the WACC? Things that companies can't control and things that you can control. So what you can't control is the market and interest rates. You just have to operate in the interest rate environment and make adjustments and decisions accordingly based on what interest rates are. And of course that means the overall economy, what kind of business you're in, what's the general attitude about risk in the economy, and of course tax rates. What is controllable though is your capital structure. How much debt versus equity versus stock do you have on the books? You control your dividend policy. How much of your earnings do you pay out versus keeping? And you also control your investment policy. Companies grow and become more valuable as they decide what to invest in. Firms with riskier projects generally have a higher cost of equity. Okay, so if I choose riskier projects to invest in, I will have a higher cost of equity. If I choose safer projects to invest in, that will come down. Most companies do a combination. As they look to grow and expand, they'll take on some riskier projects, they'll take on some fairly safe projects in some combination. But you just never know. Some companies are more aggressive than others, depending on where they're at in their growth cycle, what their competition is like, what the economy is like, and so on. But companies do influence their WACC, and so there's a lot about it that they can control, but a few things that they can't control.
And so as we talk about risk, and your chapter also talks about risk to some degree, there's really three kinds of risk that companies have to look at. And this really deals with risk of investing in projects. And companies invest in all kinds of projects. Maybe it's if you're a retailer, it could be I'm going to add new locations. If I'm a manufacturer, I'm going to expand capacity or develop new product lines. If I'm a pharmaceutical, maybe it's trying to get into some new drugs and figure out what those are. If I'm like an airline like Boeing, it's maybe developing a new kind of airplane to meet future market demands. Whatever that would be, those are projects that companies invest in. And remember, the goal of finance is to make my company worth more. I want to increase the value of my company. So I have to choose the right projects that will do that. And every project has risk. And these are the three kinds of risk we have to worry about. So standalone risk is the easiest. Market risk is typically the best. However, creditors, customers, suppliers, and employees are more affected by corporate risk. Therefore, corporate risk is the most relevant. Standalone risk is really what's the risk of a project by itself. Okay, and that's actually not that hard to calculate. Every project, as you analyze it, you can figure out how risky is this project, how certain is the outcome if we choose to invest in something. And this is companies deciding how to grow and add new projects. Market risk is how will the market look at your company? As you take on new projects, and as they hopefully work or unfortunately don't work out, how will that turn out? It says creditors, customers, suppliers, and employees are more affected by corporate risk. So that's one we really look at, which is just the risk of that company itself in the industry that it's in. And I mentioned many examples of some companies just have more inherent risk because of what they do than others. Remember that when a company issues stock, that's the only time a company receives money from selling stock is when they initially sell it. So I'm a company, I want to raise some extra funds, I choose to sell common stock. That's when I get the money. After that, the common stock is bought and sold between investors. However, when I issue common stock, I have to use an underwriter or an investment bank to help me do that. And that underwriter and that investment bank help negotiate the process, and they help mitigate the risk of doing this, but they also, of course, take their cut, which is the flotation cost or the fee that they take. So this is just saying if we were to factor in issuing new equity and now factor in the fact that we'd have to pay a flotation cost, that impacts the WACC, right? The higher the flotation cost, your WACC will go up, because the higher the flotation cost, the higher the cost of issuing stock, meaning the higher my WACC will end up being. So the cost of new common equity, just an example here, is P0 is 50, D0 dividend today 312, the growth rate's 5.8, the flotation cost is 15%, and that raises significantly the cost of issuing new stock. When 15 cents on the dollar goes to a commission to my investment banker, that's less money that I get to keep as the corporation. Therefore, my cost goes up. This is the same thing, just using flotation cost for debt now. Flotation cost for debt typically is much lower also. It's only 2%. Notice that in this example here it's just 2%. For common stock it was 15%. That's very realistic. Issuing new debt's much cheaper than issuing stock. Flotation costs depend on the risk of the firm and the type of capital being raised. Obviously, if a firm is just a riskier firm itself, the investment bankers will want a higher cut. If the firm is very safe, very well capitalized already, there's less risk in issuing new stock and debt. So therefore, the investment bankers don't need as big of a flotation cost or a cut. And I already mentioned a couple of these, but now primarily, I want you to be aware of them just as finance master's students taking a finance class. Just a topic you should be aware of. There's really almost nothing I gave you in the homework, though, that this is really going to come up too much, though. So here it just says then other components of funding from investors. So we mentioned here our big focus was issuing stock common stock, preferred stock, using your own retained earnings, and issuing debt. However, just be aware that companies also receive financing through just trade payables, deferred taxes, and accruals. Just more accounting things, if you can remember some of your accounting principles. These are just things that would come up in accounting that just kind of grow organically as a company grows. These things just kind of grow organically. If you were to shrink, these numbers would shrink. Okay, so we really don't factor these into the WACC because they're more a component of accounting rules and the size of the company than they are specifically making a decision to go out and borrow money or issue stocks. They're a little bit different animal that we really don't include. Okay, so that was chapter 3. That was all about cost of capital, the CAPM, a little bit about risk. As always, if you have questions,